In the methodical science of market analysis as developed by Richard Wyckoff, the transition of a stock from a sideways trading range into a new uptrend is a moment of immense opportunity. This event, the breakout, is the point where a long and often tedious period of preparation culminates in decisive action. It is the first public signal that the composite man, the amalgam of large, informed financial interests, has completed his campaign of quiet accumulation and is now ready to engineer a markup in price. For the average market participant, however, this moment is fraught with peril. Many breakouts fail, trapping eager buyers at the top of the range just before the price collapses. These false moves, or upthrusts, are a common tool of manipulation designed to mislead the crowd. The critical task for the serious student of the market, therefore, is to learn how to verify the power behind a breakout. It is the ability to distinguish between a genuine display of overwhelming demand and a deceptive manipulative maneuver. Wyckoff did not rely on hope or guesswork in this crucial endeavor. He formulated a series of precise tests based on the irrefutable evidence of price action and volume to confirm the validity of a breakout and to identify the exact point where the path of least resistance had definitively turned upward. This is the story of how he did it. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells us these deep dives are worth making. To fully understand the verification of a breakout, one must first briefly revisit the market phase that precedes it. Accumulation. As established in our previous discussion, accumulation is the methodical process of absorbing the floating supply of a stock. It occurs within a trading range, a sideways price channel bounded by support and resistance. The lower boundary of this range is often established by a selling climax, where panicked public selling is met by the massive buying power of informed interests. The upper boundary is typically set by the subsequent automatic rally. Within these confines, the composite man works patiently, often for months, to build his line of stock. He buys on weakness, on reactions down to the support line, and he allows the stock to appear dull and lifeless to discourage public interest and to tire out any weak holders who bought prematurely. The Wyckoff analyst watches this period of preparation for the key signs of successful accumulation. The gradual drying up of volume on declines, signaling the exhaustion of supply, and the tendency for reactions to stop at progressively higher lows, signaling the increasing eagerness of the buyers. The campaign often culminates in a spring or shakeout, a final manipulative drive below the support line to catch stop-loss orders and shake out the last of the weak hands. When a stock has undergone this entire logical sequence of events, it is technically in a very strong position. The ownership has been transferred from weak, uninformed hands to strong, patient, informed hands. The available supply of stock at these low prices has become scarce. It is from this position of strength, after a long cause has been built, that the stock is finally ready to produce the effect of a sustained uptrend. The breakout is the first stage of this effect. The primary event that signals the end of accumulation and the beginning of the markup phase is what Wyckoff colorfully termed the jump across the creek. In this analogy, the upper resistance line of the trading range is visualized as a creek, which represents a significant barrier of supply. For the entirety of the accumulation phase, every attempt to rally has been turned back at the edge of this creek. A jump across the creek is therefore a decisive, powerful price movement that carries the stock clear out of and above this long-standing area of resistance. The first and most critical criterion for verifying this breakout is the character of the price action itself. A genuine breakout is not a timid or hesitant event. It should appear on the chart as a definitive and often sharp advance, characterized by a marked widening of the price spread. The stock should cover ground easily, pushing into new high territory with a sense of energy and purpose. This is the visual evidence that demand is now fully in control and is meeting little to no opposition. A stock that struggles to clear the resistance, inching above it on narrow price bars and then stalling, is not displaying the characteristics of a powerful breakout. The composite man, having spent months preparing for this move, will not allow it to be timid. His intention is to now attract a following and leave the sellers behind, and the price action must reflect this intent. While the price action provides the visual cue, the second and most essential criterion for verifying the power of a breakout is the volume signature. According to Wyckoff's third fundamental law, the law of effort versus result, a significant result, such as a breakout into a new uptrend, must be accompanied by a significant effort, which is volume. A true jump across the creek must occur on a distinct and substantial expansion of trading volume. This high volume is the irrefutable proof that powerful demand has entered the market. It represents several forces acting in concert. It is the composite man himself now aggressively bidding for stock to propel it out of the range. It is the covering of short positions from bearish traders who are now trapped and forced to buy. And it is the first wave of buying from other professional traders who recognize the technical signal and are joining the move. This confluence of demand creates the high volume that is necessary to absorb all the residual supply that naturally exists at the old resistance level. Shares from traders who are happy to get out even. A breakout that occurs on low or diminishing volume is highly suspect. It shows a lack of effort and suggests that the demand is not powerful enough to sustain the move. Such a breakout is often a precursor to a failure, a false move designed to trap the unwary. Therefore, the Wyckoff analyst insists on seeing this harmony between price and volume. The decisive price advance of the jump across the creek, confirmed by a dramatic expansion in volume, is the first part of the twofold verification that the markup phase has truly begun. The second part of this verification process, and one that offers a superb low-risk entry point, is the maneuver Wyckoff called the backup to the edge of the creek. It is rare for a stock to launch into a sustained, uninterrupted advance immediately after its initial breakout. More often than not, after the jump across the creek, there will be a pullback or a period of sideways consolidation that brings the price back toward the level of the old resistance line. This backing up action serves two purposes. First, it is a final test of the supply. If the breakout was genuine and the composite man is in control, there should be very little stock available for sale on this pullback. Second, it serves to shake out any short-term traders who bought in the initial excitement of the breakout and are now taking quick profits. The defining characteristic of a successful backup to the edge of the creek is a dramatic shrinkage of volume. As the price recedes toward the breakout level, the volume should diminish to a fraction of what it was during the breakout itself. This low volume is the final conclusive proof that the sellers are gone. The former resistance of the trading range now becomes support, and the lack of selling pressure on the test of this new support confirms its validity. This point, often referred to as the last point of support, is one of the safest and most effective places to initiate a long position. The trade can be entered with a very close stop-loss order placed just below the new support line, minimizing the risk. The combination of a high-volume breakout, the jump across the creek, followed by a low-volume pullback to test that breakout level, the backup to the edge of the creek, constitutes Wyckoff's complete two-stage verification of a genuine buying opportunity. The stock has proven its readiness to advance, and the analyst can now take a position with a high degree of confidence that he is acting in harmony with the intentions of smart money. To fully master the art of verifying a breakout, it is just as crucial to understand its opposite, the upthrust, or false breakout. An upthrust is a manipulative maneuver designed to do the exact opposite of a jump across the creek. Its purpose is to trap bullish traders and create a fresh supply of stock for distribution. An upthrust occurs when the price moves above the resistance of a trading range but fails to sustain the advance and quickly falls back into the range. This often happens after a long advance within a distribution trading range, but it can also occur as a deceptive move out of what appears to be an accumulation range. Wyckoff provided clear criteria to distinguish an upthrust from a genuine breakout. The most telling sign is often found in the volume. An upthrust can occur in two ways. First, the price may push above the resistance line on conspicuously low volume. This demonstrates a lack of genuine demand. The move has no power behind it. It is an effort without force, and it is doomed to fail as soon as any significant supply appears. Second, and more deceptively, an upthrust can occur on a sudden burst of very high climactic volume, but the price makes very little upward progress and then stalls. This is a classic example of the law of effort versus result showing a divergence. The great effort, which is the high volume, is failing to produce a corresponding result, which would be a sustained price advance. This indicates that the apparent breakout is being met with a massive wave of selling or distribution from the composite man, who is using the public's excitement about the breakout to unload his shares at the highest possible price. Following either type of upthrust, the price will fail to hold its gains and will quickly fall back below the resistance level and into the old trading range. This failure to hold the breakout is the definitive proof that it was a false move. For the Wyckoff analyst, identifying an upthrust is not only a signal to avoid taking a long position, but is often a powerful signal to initiate a short sale, as it indicates that supply is in control and a markdown may be imminent. Thus, by understanding the distinct characteristics of both the genuine jump across the creek and the manipulative upthrust, the trader can effectively verify the power, or lack thereof, behind any breakout. Having examined the foundational evidence that verifies the power behind a breakout, the task of the Wyckoff analyst shifts. The initial phase of detection, akin to the work of a detective piecing together clues of a hidden campaign, is now complete. With the stock having successfully jumped the creek and confirmed its strength, the trader's role evolves into that of a campaign manager. The new objective is to skillfully navigate the developing uptrend or markup phase, remaining in harmony with the intentions of the composite man for as long as the path of least resistance remains definitively upward. This requires a different, though equally critical, set of analytical skills. One must learn to distinguish between a healthy, normal reaction and the first subtle signs of weakness or distribution. One must understand how to manage risk, protect accumulating profits, and recognize the key points within the trend that offer opportunities to increase a position. This is the art of following smart money, a discipline of patience, observation, and adherence to the logical principles that govern a stock's advance. The first step in following the trend is to understand the anatomy of a healthy markup phase. According to the Wyckoff method, a true uptrend is defined by a persistent and recognizable pattern, a series of higher highs and higher lows. This stair-step progression is the visual evidence that demand is in continuous control. Each upward thrust or swing should push the price to a new high, demonstrating the buyer's power. Each subsequent pullback or reaction should stop at a higher price level than the one that preceded it, demonstrating the buyer's eagerness and the absence of significant selling pressure. This simple but powerful structure is the backbone of the trend. As long as this pattern remains intact, the presumption is that the uptrend will continue. The Wyckoff analyst's job is to continuously monitor the health of this trend by applying the law of effort versus result to each of these swings. The volume signature during the markup phase is of paramount importance. On the advances, as the price moves to new highs, volume should ideally expand. This shows that the effort represented by the volume is in harmony with the result, which is the price advance. It indicates that demand is robust and is easily overcoming the light profit-taking that naturally occurs as a stock moves higher. Conversely, the most critical characteristic of a healthy uptrend is the nature of the volume on reactions. On each pullback or correction, the volume of trading must noticeably contract. This is one of the most reliable signs that a trend remains in a strong technical position. The diminished volume proves that the selling is not aggressive or urgent. It is not distribution from large informed interests. Instead, it represents passive, light profit-taking from short-term traders or weak hands who are easily shaken out. The lack of significant selling pressure allows the composite man and other strong holders to easily absorb these small offerings without disturbing the price structure, often using these reactions to add to their own positions. If a reaction occurs on high or expanding volume, it is a significant warning sign. It suggests that supply is coming into the market in a volume that is comparable to the demand seen on the rallies. This divergence between effort and result, heavy selling pressure that halts or reverses the advance, indicates that the trend may be in danger. Therefore, the Wyckoff analyst pays meticulous attention to this interplay, expanding volume on the advances and contracting volume on the reactions. This continuous confirmation of demand's dominance provides the confidence needed to hold a position and ride the trend for a substantial move. Within a major uptrend, it is rare for a stock to advance in a single, uninterrupted line. The markup phase is typically punctuated by periods of consolidation or sideways movement. Wyckoff referred to these formations as re-accumulation zones, or, more colloquially, as stepping stones. These are essentially smaller-scale trading ranges that form within an established uptrend. After a stock has made a significant advance, it will often pause and move sideways for a period of weeks. To the untrained eye, this pause may look like a top, causing fear and uncertainty. However, to the Wyckoff analyst, these stepping stones are highly bullish formations and represent a crucial part of the markup process. Their function is to allow the stock to rest and digest its previous gains. During these periods, the composite man is achieving several objectives. First, he is absorbing the stock being sold by early buyers who are content to take their profits. Second, he is shaking out nervous or impatient traders who become frustrated with the lack of immediate upward progress. By absorbing this profit-taking and cleaning out the weak hands, he consolidates his control over the stock and prepares it for the next leg of its advance. These reaccumulation zones are to be analyzed in exactly the same way as a primary accumulation base, only on a smaller scale. The Wyckoff student looks for the same signs of strength within this smaller trading range. He watches for volume to dry up on the reactions to the support of the stepping stone. He looks for a potential spring or shakeout within the formation. And he waits for a smaller scale jump across the creek as the price breaks out of the top of the reaccumulation range on expanding volume. These formations are incredibly constructive because they not only confirm that the uptrend is still healthy, but they also offer excellent low-risk opportunities to add to an existing position, a practice known as pyramiding. Each successful stepping stone serves as a new, higher level of support and acts as a launch pad for the next phase of the advance, reinforcing the overall strength and integrity of the uptrend. To visualize and manage the uptrend, Wyckoff employed the practical tool of the trend line. A basic uptrend line is drawn by connecting two or more successive reaction lows. This line is not an infallible signal, but rather a tool to help the analyst visualize the stride or angle of the advance. As long as the price remains above this line, the trend is considered intact. A break of the trend line is not an automatic sell signal, but it is a critical warning that the character of the market is changing. It signifies that the advance has at least temporarily lost its momentum. The meaning of this change must then be determined by other evidence. A broken trend line could mean that the stock is simply entering a new reaccumulation phase or stepping stone, after which the advance may resume, perhaps at a different, more sustainable angle. Or it could be the first sign that supply is beginning to overcome demand, potentially signaling the beginning of a larger topping formation or distribution. Wyckoff cautioned against using trend lines in a purely mechanical way. Their value lies in providing hints and directing the analyst's attention to critical points where the market's behavior must be weighed with extra care. The practical management of a position during the markup phase requires a systematic method for protecting profits while still giving the stock room to move. The most effective tool for this is the trailing stop-loss order. Wyckoff's logic for managing a trade was to let profits run but never to give back a substantial portion of them. The trailing stop is the mechanism that achieves this balance. The method is as follows. After the stock has made a new high and then completes a normal, healthy reaction on diminished volume, the stop-loss order should be moved up to a point just below the low of that reaction, This process is repeated as the trend progresses. Each time the stock moves to a new high and successfully completes a subsequent pullback, the stop is trailed up behind it, locking in a greater portion of the paper profit. This technique is brilliant in its simplicity. It prevents the trader from being shaken out by the normal, healthy reactions that are a necessary part of any sustained advance. At the same time, it ensures that the trade will be automatically closed if the character of the trend changes. For the uptrend to be broken, the stock must, by definition, violate the previous reaction low. By placing the stop there, the trader is forcing the market to prove that the trend is over. This method removes the emotional element of deciding when to take a profit, replacing it with a logical, systematic process that protects capital and maximizes gains during a sustained move. For those who wish to truly master the lessons discussed here, it is essential to study them from the source. Please take note of a unique new edition of Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds, by Max Davidson. It has been meticulously adapted for the modern trader, complete with explanations that make Wyckoff's timeless wisdom more accessible than ever. For anyone who wants to truly absorb the lessons we are discussing, this adapted edition is an indispensable part of your library. The link to this book is located in the description of this video. In conclusion, verifying a breakout and successfully following the smart money through the markup phase is a dynamic process. It is not a one-time decision made at the point of entry, but an ongoing campaign of analysis and prudent management. It begins with the strict verification of the breakout, ensuring that the jump across the creek is supported by the irrefutable evidence of wide price spreads and expanding volume. It continues with the skill of navigating the subsequent uptrend, correctly interpreting reactions by their volume signatures, identifying re-accumulation zones as opportunities, and using a logical trailing stop to protect profits. The Wyckoff analyst remains with the trend as long as the evidence of healthy demand persists, strong volume on rallies and light volume on reactions, and as long as the stair-step pattern of higher highs and higher lows remains intact. His job is to stay in harmony with the composite man until the first signs of large-scale distribution begin to appear, a topic for a future discussion. This entire process transforms trading from an emotional gamble into a disciplined scientific business.